Hey guys, Mike here. So obviously big day in the market tomorrow. We're sitting here getting CPI data at 8:30 in the morning, so it's going to be huge. And the question is, what's the market going to do, and what's the data going to look like? So what do I mean by history repeating itself? I'm going to explain that and show you some data which might make you look at things a lot differently here and what just might happen in the month of February. And the first thing we're going to do is listen to the largest investment institution who has $10 trillion under assets. That's right, 10 trillion with a T. Okay, their CEO has like all the former presidents and the current president on speed dial because they ask his advice when it comes to the economy and things like that. And so, always good to get their perspective on what they see coming tomorrow and even in March, because they have a huge company with a lot of analytic teams, okay? And they tend to get information that we don't have access to. So, and they've been pretty spot on so far with what they've talked about when it comes to inflation. And so, then we're going to go over the data I'm talking about history repeating itself, and why you might see, believe it or not, the market absolutely take off. Like why you could absolutely see that with the data tomorrow if it comes in even a smidge under or even right on point to what they believe it's going to be. And then I'm going to leave you the question to ponder from a very smart man, right? And when he asked the question, I listened to it and I thought, yeah, he's got a good point. He's a pretty smart guy. So, I'll leave you with that to ponder, okay? So if you get anything out of it, hit the like, subscribe button. I really appreciate it. And let's get into this.
The focus around what are extraordinary. We haven't seen these sort of inflation numbers in decades. And so, the markets are jittery around. Listen, it's going to be a strong number tomorrow. I wouldn't argue with the number you put up on the screen. Core CPI, we think is going to be about a 6% number. Listen, I think we're going to see a strong number here. You can never predict one number, but I think you're going to see a strong number here. I think you're going to see a strong number next month. Listen, then I think as you get into the spring and summer, you're going to start to see some things kick in. Some of the supply chain dynamics will improve. I thought Steve showed a interesting set of conditions earlier today about you've got supply chains that'll alleviate a bit. You'll get some of the base effects kicking in. Energy should come off the boil. So listen, I think it's coming down. The projections I think he showed earlier that we come up with the same thing quantitatively, that you get core CPI, core PCE, which the Fed focuses on, back down to around 3% by the end of the year. So it's gonna run hot today. By the way, the thing that is still going to be sticky high is wages, and that is the one. By the way, the one number tomorrow is rents. That's the other sticky thing that we're going to focus on quite a bit when that number prints. Listen, by the way, part of this, it's hard for the Fed to impact rent when you don't have enough inventory. So the question is, how much does a Fed have to go after this when it's really hard for the Fed to modulate some of this inflation?
And that's something we've been talking about here for a while, right? Like, how does the Fed bring down inflation when they don't control wages and they continue to go up? I don't know if you saw the news what Amazon did with their corporate employees, almost doubling it just because they need help. And, then rents, they can't control rents or anything like that, and they're going through the roof. Then you had Ford and GM come out today, for those who didn't see it, and admitted the reason why car prices are so high is because the dealerships are basically price gouging us, right? And, Ford has warned them to stop doing that. Like, they're going 10% over what they need to be charging for those cars, and rightfully so, because they're trying to make up for what happened when they were shut down, right? But that's why it's happening. I think you're seeing that across the board in a lot of places, right? They're trying to make up for being shut down for almost 6 months to a year, and so they're going to make us pay the price. So eventually, yes, maybe they'll bring it down, but they call wages sticky and rent sticky because it's hard to go back on that, right? Once you've given somebody a $15 wage or a $20 or $30 wage, like I said before, what are you going to do? Just lay them off a year from now, the whole workforce, and start over? Or announce, yes, we're going to be lowering wages by 20% or something? Good luck with that. We'll see how that goes. And so that's really the interesting part. Then you got, of course, oil still going through the roof. And so that's what's going to be interesting to see the numbers. Like I said, is it going to be hot? It should be hot. But again, what you're looking at is it hit the number on the head, just like it did back when they reported in January, or does it come in a smidge lower, okay? And so, because remember that, what's the market been doing? What do you hear? Or they're trying to scare the daylights out of everybody, right? First it was going to be 3 rate hikes, then 5 rate hikes, then 7. Heard one come out the other day. These are major institutions, 9 rate hikes. Are you kidding me? We got a Fed that won't even commit to 1 right now in March. They won't even say that. I can imagine them, no matter how hot it comes in tomorrow, getting that much more aggressive. Seriously, look at these guys. And so, maybe I'm wrong. Maybe they could do it. but I'm just going, past behavior predicts future behavior, and so if you've been conservative this whole time, I don't see you getting much more aggressive or anything, especially now the market's kind of cooled off a little bit, ran down some, but also here's the percentages right here. You can see on the odds of them raising rates, you're looking at anywhere from 25 to 50 basis points. They're looking at about 71% chance. And then you're looking at 50 to 75 basis points, around 28% chance. And then the other thing is, what do we got to do to get inflation down, right? I mean, that's kind of key. And so this was laid out, and I enjoyed this roadmap where, the virus has to end, right? Everybody has to go back to normal. Supply chain bottlenecks have to clear up. Physical stimulus runs off finally and ends, and then you got goods purchase normalize. And it goes back to what Kathy Woods has said multiple times when it comes to the double ordering that companies are doing, and that's why she sees inventories up. And the reason why they're doing that is because they're afraid they won't be able to get it, because that's what happened in 2020 and 2021 to them. And so, that's keeping prices high. Of course, that should alleviate. Most people are projecting third, fourth quarter, which, of course, if that happens, you should start to see prices come down, inflation come down, that is. And so that'll help. Plus also what I call price gouging, but all these companies that are, raising prices more than they should and try to make up for all the money they missed out on when they were closed. And so that's another problem, which I don't know if the government can get involved in that, but that needs to stop. At least Ford and GM are honest about that and warn them to stop. We'll see how that goes. We'll see how car prices, because remember, that was one of the things driving inflation, that and rents. Okay. And so now what are the things that could absolutely lead to the markets melting up after tomorrow if we come in right at the number or right below the number, right? And there's any signs of it even leveling off or slowing down. Well, one thing you can look at is obviously the 10-year yield. And just starting off with a 10-year yield, you can see there is this major support / resistance level right here. Currently, it is resistance, and it has been for the last 3 years. You can see we just rejected off of it the other day. You go back to 2019, which is the last time we were up this high, rejected 3 times, and then it was obviously support right before that. And then if we go back to 2017, you see it bounce right off of that area. And then you see in 2016, rejected, and then you see it is support right there. And you can see also when we get to this level, what happens, the RSI you see is normally oversold one time right there, and then it came back down, market went up, another time right there. And then you look back over and you can see right here, back in 2019, same thing happened. And of course, the other thing to look at is all of the shorts that have bet against the NASDAQ. I mean, you see to the right over there, it's through the roof. We haven't seen it this high since around March 2020. And I think that's what you've seen over the last 12 days is a lot of shorts covering their positions right now, right? Because they're so sold off, but they realize what can happen tomorrow. It's either going to be a catalyst that pushes way down or a catalyst that's going to absolutely ignite something, right? And if that market starts to take off, those shorts are going to have to cover, which is going to drive it up even faster. And it's really not that big of an ask, guys. I mean, we're right at the 10% mark right now on the NASDAQ. So it's only 10% down right there. And quietly over the last 12 days, what have we done? We've gone up 6% on what news? What good news have you seen come out to drive the NASDAQ and growth stocks up 6.33%? The answer is nothing. I mean, you had the Facebook meltdown, the Netflix meltdown, Peloton did meltdown, and they got this maybe a buyout thing going on or whatever, but it'll end up melting back down. And so just in the NASDAQ in general, there hadn't been really anything out there, but a lot of people I've seen out there talking about it. So I think what you see is shorts are covering over the last couple of weeks, right? Because they've just driven the QQQ down into the ground. All the stocks on it have been driven down dramatically in numbers that people never thought they'd see on some of these stocks, even the FANG stocks, right? And so, it's surprising. It's been a quiet 6.6%, hadn't it? I mean, if you didn't think about it, you probably wouldn't think the QQQ would come up that much in 12 days, but it has. And so one thing you also get, you got to be careful about is I look back in December and January, and the market bought up the 3 to 4 days prior to the CPI data and then ended up selling off. So that's something else we got to look at. But when you see this many people with this negative sentiment right now, and you see the fear and greed index has been floating between 35 to 42, somewhere in there, this is when you get to see stocks take off and the shorts get caught literally with their shorts around their ankles. And so, that's the thing to look out for tomorrow. And then, of course, if we do start shooting up, odds are, if they do end up raising rates in March, normally you do get a sell-off right after that. So, we'll talk about that, and I'll bring out another detailed video on that. But, the one question I love, and I really like this guy, I respect him. He's an older gentleman, and, he's a Wharton professor, one of the top business schools out there. He's been around a long time, and he's seen a lot in the market, okay? And he has some really good calls on this. And, I love his question to Jerome Powell. And, just take it in, and then, give me your answer in the comments. What do you think?
It's my basic problem. The Fed says the long-term Fed funds rate on normal conditions is 2.5% with 2% rate of inflation. If you take a look at their dot plots all the way to the end, and they've done this for years, 2.5 is considered the normal rate for the Fed funds rate. Now we have 7% inflation. And by the way, next week, we're going to get another inflation announcement. I expect it to jump even further above 7%. How does 1% stop 7 when they say 2.5% is consistent with 2? In addition, Powell admitted in the last news conference that we have one of the strongest labor markets we've ever had.
And so, that's what I've been trying to figure out this whole time. And he's right. If you look at the Fed's funds rate, when they started raising it in 2015 to 2018, we had 0% inflation. It was something 0.1% or something like that, but it was non-existent, right? And so, how raising it 0.25%, or even getting to the end of the year, it's like when we won at the max. Like, how does that really help you fight inflation? And the answer is, it doesn't. Right, it does. Even Fed Chair Powell said it'd be over a year before any interest rate hikes actually have any effect on inflation. I mean, his whole bet, like, they've literally pushed the chips in the middle that's stopping bond and mortgage-backed security purchases, which should end next month, and then maybe letting some of the stuff roll off the balance sheet, maybe, and then supply chain issues fixing themselves. That's what they're pushing all the chips in the middle on, hoping that's what brings down inflation and get us to around 3% by year end, and they consider that a victory. And so that's what they're doing, and we'll see. I mean, maybe he changes the tune in March, depending on the numbers tomorrow, but I mean, I doubt it at this point in time, but we'll see. And what the market's doing is they're trying to price in the worst thing now, and that's why you see them coming out with these crazy 9 rate hikes and all this stuff like that. And they're just trying to price it all in. Remember, they try to think 6 months out. And so the biggest question that can never be answered, you can't even see it until it starts to happen, is this priced in yet? Is 5 rate hikes priced in? Is higher inflation priced in? Have they done that? I'm talking about the institutions, not us. And so that's, a big answer we will get tomorrow, depending on what the numbers are. Again, if you see a spike and we start to run, right, don't be surprised if we sell off in March if the Fed does decide to start raising interest rates. That's happened before, right after the interest rate hikes are announced, and then maybe we start to move back up. But so anyway, not to get too far ahead of ourselves, that's what I want to put out there to you. Hopefully you got something out of it. Let me know what you think in the comments. Let me know what you think about his answer. Maybe he's totally wrong and the Wharton professor has no idea what he's talking about. But anyway, hope you guys have a good one. Don't forget, crypto's still running. So if you want to open an account with BlockFi, by clicking on that link down below, end up getting almost 8% on your stable coins, anywhere from 4 to 4.5% on your Bitcoin and Ethereum as well, guys. Have a good one.